All right, so the first topic that we want to talk about is correlations. So this is like the bulk of the topic.
Okay.
There are many different markets that are correlated with what you trade. So you trade mainly Nasdaq and the Dow, right?
Yeah.
Like the
hmm
indices.
hmm
The closest correlation between the Nasdaq and the Dow are the Nasdaq and the Dow itself. So when you look at both of those markets,
hmm
they both move in tandem, right? If one goes up, usually the other also goes up.
Correct.
So that's the most obvious correlation. So we'll just talk about that first.
hmm
So the way we use correlations, there are two main things, and the first one is, you've probably heard it before, is relative strength analysis or relative strength correlation.
Yeah, I learned it from you.
Yeah. Oh, yeah. Oh, excellent. I
Mhm.
wanted to talk because I always mention relative strength, but I don't really go into why it works or why we even do it,
Okay.
or the reasoning why we do it behind the scenes.
Okay.
So with relative strength, I'm just going to go to one of these examples. It's loading. Give it a second.
hmm
Okay. So with relative strength, uh, when we're looking for a bearish trade, for example, which one do we want to participate on? Do we want to participate on the strongest or the weakest in a
The,
bearish trade?
the strongest.
When
The
it's a bearish trade, we want to find the weakest pair.
Oh, the weakest pair. Oh,
Yeah.
okay.
So I'll just visually, to might be a bit easier to see. So this was actually a very similar example. This one's a bit better over here.
Okay.
Okay, I'm just going to swap it around. So if we're looking for a bullish trade, so for example, both of these examples here are bullish trades.
Okay.
We want should we look for the strongest one or should we look for the weakest one?
You said the weakest one.
What about a bullish trade, like a trade to go up?
Oh, going up. The strongest one.
Yeah, yeah. So if we want to place a trade going up, a bullish trade, we want to find the pair that's the strongest. And the
Mm-hmm.
reasoning behind that is when we find the strongest pair, that just means that pair is much more sensitive to any bullish price.
Okay.
So if, for example, the next candle is a bullish candle, right?
hmm
Then when we compare the Nasdaq and the Dow, if the Nasdaq is, well, I've just lost it.
Mm.
If we compare the Nasdaq and the Dow, if the Nasdaq was much stronger than the Dow, then the next bullish candle, it would be much larger on the Nasdaq and it would be much smaller on the Dow.
Gotcha.
So for example, I've got one example here. It says relative strength is similar. So when we apply relative strength, how would you go about finding which one is stronger or weaker? Have you done this before?
No, I kind of see it honestly when I was looking at the in correlation between the dollar and the VIX, and whatever's the strongest one that shows me more movement, I go by that one for the
Between the
correlation.
dollar and the VIX?
Yeah,
Oh yeah, I see.
yeah, that's one way I was using it to show a little bit more. Because I usually just trade the US 30 or the Dow, and the Nas. It seemed like the Dow is more sensitive to it just from what I've been seeing. But I do see with the US, like the was it the SP 500 was way more moving than um the US 30 or the Nas. So I guess that would have been relative strength as of
Yeah.
yesterday.
So
Yeah.
whenever there's like a bullish move on the dollar index, because they're inverse markets, if there's a bullish DXY, then there's going to be a bearish indices.
hmm
And sometimes you may see that the Dow might be much more sensitive towards any bearishness, and then
hmm
maybe the Nasdaq is barely being bearish. So
Right.
you may just have had like a streak of really sensitive Dow movement,
hmm
but with relative strength, you can constantly analyze which one is stronger or which one is weaker,
Gotcha.
rather than just generalizing it.
Gotcha.
Yeah. and we can do it on a case-by-case basis. So what that means is whenever you have a trade, is your entry strategy the RMR strategy?
Yes, and that's what I wanted to go over to a little bit. Just, but yes.
I'll go over that as well, but we'll do the relative strength first, so we just stay on one topic.
Okay.
So when you get to your entry position, whether you're entering based on a fib retracement, based on an order block, getting into there, or getting into a gap, whichever one you choose, doesn't really matter. At the exact time of your entry, for example, let's say this candle is our entry at 4:35. When you draw a fib, the purpose of drawing the fib is to just see how deep price is retracing at that time. So when we drew that fib from the bottom to the top, usually it's at the bottom of the RAID to the top of the market structure shift. We look at how deep price retraced, and in this case it's at around 60% it retraced. And if we drew the equivalent on the Dow, you can see at that time it retraced around 50 to 60. So it's very similar. This was a very similar example. So what this means is the relative strength when we compare NASDAQ and the Dow, that they have very similar strength of bullishness. So if there's going to be bullishness for the day, they're both going to be pretty similarly sensitive. So whether you pick NASDAQ or you pick Dow, it doesn't matter as much. You don't really need to take advantage of it then, because it's quite similar.
Gotcha.
Okay, this is the next example. This one is where the relative strength is very clear. So on the first one, it was quite similar, like you can't really tell the difference. But on the second one over here, let's say we're looking for that RMR pattern again. Let's say we had that RAID, market structure shift. Now we're waiting for that retracement. And when we draw that fib, bottom to the top of the shift, price retraces pretty deep, almost to 100% on the NASDAQ. And on the other hand, on Dow, if we draw that same fib, the fib at the bottom starts here. The top is at 10:05. So if we drew that fib, you can see that at the time of the entry at 10:50, Dow would have completely just failed. It didn't even retrace. It would have just broke the swing low.
Gotcha.
So obviously, which one is stronger and which one is weaker at this point?
NAS is.
So the top one is stronger or weaker?
Yeah, stronger.
Yeah. So this one is pretty obvious to see that NAS is stronger. So in these cases, if you're looking for a bullish trade, then obviously you want to participate on the strongest indice, the one that's more sensitive to bullishness. So this is like a little hint that the market's giving to us that NASDAQ is much more sensitive to bullishness. So even on the next retracement, like even if you didn't get in here, the next retracement, it still retraces into another gap down here. You can see the price action afterwards. What does NASDAQ look like afterwards? It's
all bullish run, and
it's pretty obviously bullish, right? Yeah, but if we took that same long on the Dow, what would it look like if we had that long on the Dow? It's much more different. There's a lot of bullishness on the NASDAQ, but there's barely any bullishness on the Dow.
Gotcha.
Yeah. So when you apply that simple relative strength step, sometimes you can even get yourself out of a losing trade. For example, the Dow might even just fail completely and get you stopped out. But on the NASDAQ, because it's much more sensitive to bullishness, it might not even reach your stop out area. It might save you.
Gotcha.
Yeah. And then if you're not aware of relative strength, sometimes you might be thinking, oh, why did this trade stop me out on the NASDAQ, on the Dow, but it didn't stop me out on the NASDAQ? But when you have relative strength in mind, you can get an idea like, oh, I guess during my entry time, NASDAQ was the most strongest, so I should have long the NASDAQ instead of the Dow.
Yeah, I get tripped up sometime like that.
Because I still see a lot of people in the server, they post a lot of their thoughts, but very rarely they mention relative strength still, and I try to make it quite a important part because it's actually a step that I never miss whenever I trade indices. It's like that one step that I always do.
Gotcha.
Yeah. I just want to segue briefly into, there was this bullish trade over here, for example.
Mm-hmm.
In a couple topics later, we're going to be talking about bias, right? And
Okay.
when we talk about bias, a big topic I want to talk about is liquidity and what we aim for and what our objectives are. And the main thing is that our objectives are pretty much purely based on liquidity and where the money rests in the market.
Gotcha.
And so I just wrote a note up here saying we had this bullish RMR trade over here, but we need to know what our objective is, or what are we reaching for? Like, how do we know to take off anything or take off a partial before price just dumps? And if you look at this swing high, I just labeled, is it a normal high? But if we look to the left and we drag it out, it's not just the normal high, it's actually an equal high. So the liquidity that was built at this point the money didn't get taken over here. So what I call this is the generation of liquidity.
Okay.
And when we talk about having a bias, because with bias, everyone wants to, like, before the market's even open, they want to have like a weekly bias, they want to have a daily bias of where the market's going to go. But when there's no obvious area of liquidity, like there's no obvious equal high or equal low that's near price, it's hard to make a bias, right? So the way I make a bias when there's not really anything obvious is I wait for liquidity generation, because liquidity is generated all the time in the market. So that means equal highs are being generated, equal lows are being generated, and as soon as this high is not taken, like it forms this swing and doesn't take the high and it's just rejecting, then alarm bells are going off in my head. Now this is my bias. My bias has just been formed. So when people are like, oh, what's your daily bias at the start of the day? I don't know what my bias is. But
Gotcha.
as soon as something like this happens, then alarm bells should start ringing. Okay, what time is it? Maybe 9:30 is around here. My bias is now bullish. Now I'm only going to look for bullish RMRs. I'm not going to look for any bearish RMRs because I have a bias now. And then you completely filter out one side of the market. So you're now just locked into one side. You're locked into a bias, which is usually the more likely direction because it has more reason.
Gotcha. So you're saying that since it was it rejected from that area, we shouldn't be looking for no sales or anything, but just more bullish in that scenario?
Exactly. Because when you have such a clean area of liquidity that's being generated, that's been formed, you know that the money is up here. There's a lot of money up here. We have resistance traders that are shorting here. We have breakout traders that are longing here. We have stop losses just forming here. There's so much money at this area. So even if you get like a clean bearish trade, I would not take any bearish trade when we're so close to these equal highs, because it's there's just so much reason for price to go there.
Gotcha.
And if we can justify such a clear reason for price to go in the opposite direction of our trade, then obviously I don't want to be in that market.
Gotcha.
I guess you could choose to maybe risk half your risk tolerance or a quarter of your risk tolerance, but for me, if I have such a clear conflicting objective, then I just won't take any opposite trade.
Gotcha. Okay.
Yeah, okay, sweet. Okay, so this one is a very clear relative strength example. I'm just going to leave the chart here real quick, and I want you to tell me a bit about relative strength when this is the point of entry. If this is the entry point, I want you to comment on the relative strength.
Well, it seemed like the second one has a relatively strength because, I mean, I guess it's after the fact. the move seemed like more volume in it from the first one. So I would go. Was the bottom was the
Bottom one is Dow. Yep.
Yeah, I would go for the Dow. Just by the first two candles, it seemed like that movement. Well, even the what's it? 1, 2, 3, fourth. The fourth candle would let me know as well that would have been a better move, because that one has way more volume in it than the NAS.
Like the future candles.
Yeah.
I suppose in hindsight, I guess, but when we obviously don't have the benefit of hindsight when we're trading live.
Yeah.
So what I wanted, what if you apply? How would you draw the fib? If you were me, how would? And we didn't know the future.
Okay.
So we're right there at price. And if you didn't know what the future was after that red line, what do you think? Or if I wanted to short, which one would I short, and how would I draw the fib?
Good question.
We'll do the fib for the top chart first. Where would you like to put the first anchor?
Let's see. I guess it would be from the top of here. Yeah, from there.
Yep.
To the bottom of that leg. Yeah.
This one?
Mm-hmm.
Or this
With
one?
that one, yeah.
Oh, yep. Okay. And then if we draw the equivalent fib on the Dow, so I'll just draw that equivalent. So top of that swing, bottom of that swing. Okay, so how deep does NASDAQ retrace?
And that's the top. It doesn't retrace as much as the Dow.
What can you see the percentage or the color? Like how deep does NASDAQ retrace?
It goes up to the blue.
Yep. So I like to make my fibs in just tenths, so it's pretty easy to see like how comparing. So NASDAQ retraced around to blue, so 60%. What about Dow?
Dow did to the I don't see the percentage on here, but to the second blue. Oh, is that the 90%?
Yeah,
90?
Yep.
Yeah.
So 90+%.
Yeah.
So just based on that, nothing else. NASDAQ retraced to about 60, Dow retraced to about 90. So is this a bearish RMR setup or a bullish RMR setup?
I would think this is a bearish RMR setup.
Yeah.
Am I correct?
Yes, a bearish RMR, because we're drawing the fib downwards, so it's a bearish setup. Yep. So if we're looking for a bearish setup, which one do we want to participate on? Do we want to participate on the strongest one or the weakest one?
We said on the bearish is the weakest one.
Yeah, and why do we want to participate on the weakest one?
I'm a little bit confused on that part, because you said the strongest one, the bull, and the weakest on the. So the weakest one would be the NAS, I guess.
The weakest is yep, that's correct. So the weakest is the NAS because it didn't have as much sensitivity to retrace higher. It retraced much lower than the Dow.
Okay.
So the NASDAQ is it was weaker at this point, at the entry point. And
Gotcha.
So whenever we do relative strength, we only care about which one is stronger or weaker at that entry point.
Okay.
So whether it becomes stronger or weaker later, who the fuck knows, right? But
yeah,
we can whether it's the strongest or weakest at that entry point, that's what we care about. Because if it's weaker at that point, chances are for the next few candles, it's going to continue to be the weakest. It's much less likely for the weakest to just suddenly become much stronger than the others. So when we do relative strength, we just care about which one is strongest or weakest at that entry point.
Entry point. Okay.
Yep.
Gotcha.
So back to this. NASDAQ retraced smaller, so NASDAQ is weaker. That means we'd place our short on NASDAQ instead of the Dow.
Gotcha.
Yep. And I just have another low here. What do you think I'm gonna draw this towards on the left? What do you think's on the left? Just me labeling this as is this a normal low?
Another relatively equal lows.
I'm just gonna where is it?
I guess no, there's nothing.
No, there must be something. Yeah, right there. The Friday equal, like it's so clean, right? Like the money there, not even a bit was touched. It's so clean. It's too clean. So who knows that? Who would know that this would be the bias for the start of Monday? No one would know that. It's not clean enough. In fact, as the day progressed, Monday and Tuesday made equal highs. So this became the bias for this trade. But that's it. Not for anything further, just for this trade. And then as the day progressed, what's our bias? We just have a low here. We have a low here. Nothing too interesting. How would we know that this would be the bias? We don't. We're just guessing. Like if we're comparing this high and this high, how do we know which one's going to be reached? We don't really know.
No,
because it's not one of them isn't that much cleaner than the other. Like I can't say that this high has much more money than that low. I can't say that. We can make an educated guess, but it's not obvious. We want to trade towards more obvious areas, because if you keep trading towards the obvious areas, like obviously you're gonna have a higher success rate than trading to less obvious areas.
Gotcha.
That's just how it works. Yeah. And so when this low, once again, like deja vu, like this over here, this high didn't take the money and rejected, like it happened again. This low didn't get taken, so instead liquidity was generated instead. So it became the bias for the day. And so if that became the bias for the day, then we're only going to be looking for bearishness. We're not going to be looking for bullishness anymore. And so if we wait for that retracement again, over here, let's say we didn't get in on this short over here, we wait for another retracement. We have a gap over here, right? The easiest entry method is just a gap because it's easy to see. Let's say at this candle at 11:45, we wanted to place a short with our stop loss at a swing high over here. And do we place it here, or do we place it on the Dow, or do we place it on S&P? How would we find out which one to place it on at this time?
The weakest one, correct?
Yeah, we place it on the weakest one. And like we did before, I'll just do it pretty quickly. But if I drew a fib, it's the same process over and over again. We draw that fib, top of the raid, bottom of the shift. At that time of the entry, which was 11:45, going into that gap, it was around like 50-60% around there. But on the Dow, at that time, it was already at 60, 70, 80%. It was much stronger. So NASDAQ was weaker, so we'd placed the short on the NASDAQ. And then as the day progressed, if we just draw that hypothetical short on Dow, first of all, on the Dow you would have got stopped, because usually you put your stop at the swing high. So this would have been stopped. On NASDAQ, it didn't get stopped, and it also reached that liquidity generation objective.
Gotcha.
Whereas on the Dow, not even close to breaking any sort of swing low. It just, see this pump over here? This huge pump, it's not huge, but this really sensitive pump on Dow. Because NASDAQ was weaker, it's more likely for it's less likely for NASDAQ to have a pump like this, because it's less sensitive to bullishness.
Gotcha.
Because over here, Dow was it was stronger. So because it's stronger, it has more sensitive to any bullish candles. So as soon as there's like one sensitive bullish candle, Dow is just pumping, but on the same candle, NASDAQ barely pumped.
Gotcha.
Yeah. So this is like the difference in relative strength. Gotcha. Yeah. Cool. Do you have any questions on that?
Well, I guess it wouldn't matter. I was going to say something, but I guess it wouldn't matter. You could probably trade either or if they both were equal.
Yeah.
So that's why I was like, never mind.
When they're similar in relative strength, like this one over here.
Mm-hmm.
Like there's a raid, there's a very decisive market structure shift, and price returns into a bearish order block, right? It retraces into that. On NASDAQ, it retraced to 90%, so it's a pretty deep retracement.
Yeah.
On Dow, it retraced to almost 90%, but in this case, because they're so similar, it doesn't matter as much which one you pick.
Yeah. Okay.
Yeah, so when they are obviously different in strength, then it's like the market giving us their hand, like to say, how do I say it? It would be disrespectful not to choose the one that's weakest during a short, right? Like it's giving us this difference in strength. Why wouldn't we take advantage of it?
Okay.
Yeah. One thing I want to add on is if relative strength is similar, like you can't really choose between them because they're so similar, then you pick the one that has a cleaner objective.
Okay.
So here on the NASDAQ, over here we've got, once again, an equal low that has been generated, right? That low was generated, equal low here, equal low there. So much money is below at the moment. On the Dow, those lows were taken.
Gotcha.
So NASDAQ has even more reason to go lower because the money is still resting here, whereas the money on the Dow was taken out.
Okay.
Yeah, so even though relative strength was similar, because NASDAQ has such a clean objective rather than the Dow, then we'd still want to choose this one because it has more reason to go lower.
Gotcha.
Yeah. But you can see in hindsight, obviously both of them went lower, and the strength of both of them going lower is pretty similar, right?
Yeah, they are.
Yeah, they're pretty similar. But this one has a cleaner objective, so I'd choose the NAS in that case.
True.
All right, I think that should be enough for relative strength for now. There were a few more examples, but I think I'll just screenshot them for you to do like a little exercise for you.
Okay, yeah, I kind of got it now.
Yep, sweet. So let's move on to the other type of correlation. So the first correlation was just between indices and their relative strengths.
Okay.
And the second one, we already talked about it a bit, but it's just about correlating objectives. So what that means is, where's that example? This one over here. When NASDAQ has such a high reason to go lower, like it has all these equal lows, if we're only looking at the Dow, we wouldn't be able to see any of those equal lows, right? If we're just looking at the Dow, the lows are taken. We'd think, there's no more reason for price to go lower. Price is more likely to just retrace and be bullish. But if we just had a quick look at NASDAQ, you'd see that because it's such a correlating market and it also has clean equal lows, this is a correlating objective. And then you'll be thinking, okay, NASDAQ is hinting to me that there's more reason to go lower. So on the Dow, there's also more reason to go lower.
Oh, okay.
Yeah. So correlating objectives are just like, it's like a little treasure hunt. When you find these little hints in correlating markets, they can give you an idea of where the market will go if you're not sure where objectives are.
Gotcha.
Yeah.
So it wouldn't matter even like if the Dow had a better objective than the NAS. We would just follow, if we were trading the NAS, what Dow would do, even though it's, I guess, it doesn't move like the, how can I say this? If the Dow had more of the movement, NAS would just follow it too. Am I saying that correctly?
If it has more movement?
Yeah, like if you still have different treasures, like you're saying that, hey, look like the NAS would go down even more.
So they all have, because they're closely correlated, they're not like NAS 100 compared with Euro USD. They're correlated markets, so if one goes up, the other goes up. But with indices, NAS 100 and US 30, they're closely correlated. So if if there's going to be bearish in one, they're going to mirror quite similarly. Like every single day, they look pretty similar.
Right.
The only times they have slight differences is during key times, like during news, equity open, and that's when we use relative strength.
Gotcha. Because I always thought the SP 500 leads, then the NAS 100 follows the SP 500, and then the US 30 follows the SP 500.
I mean, if that was the case, then that would be such a nice pattern to go off of.
Yeah.
But unfortunately, I don't. From my experience, I don't think that's a thing.
Gotcha. Okay.
But what do you mean by lead? Like when S&P will go one direction and the Nasdaq will follow that direction?
Yeah, that's why, all this time I always thought the SP 500 is the leader of it. Then all follow the SP 500. But like you said, sometimes I'll see the SP 500 go, then the US 30 just stalled, or the NAS, it would be like, it'll be differently. So I always
it swaps all the time, right? Yeah. So I guess instead of thinking if one leads or one trails, then just try to view it more as where the objectives are, where the liquidity is.
Gotcha.
Like if we look at NAS and S&P, instead of thinking this one's now it's bullish, so maybe Nasdaq will have some more bullishness, we think of it in a way as, I wonder where the liquidity is in S&P. Let's see, maybe S&P has clean equal highs, but on the NAS there's no clean equal highs. So then if we look at S&P, we see that there's a reason to go up rather than maybe it's leading or it's trailing.
Gotcha.
Yeah, okay,
yeah.
Sweet. Yep. So it's like a correlating objectives is like a treasure hunt to find little hints on the direction.
Okay.
Yeah. Like that example, like all those examples I showed with liquidity being generated, it was only being generated on one of the markets. It wasn't being generated on the Dow.
Gotcha.
So when it's being generated, that's like the hint to us. Yeah. Okay.
Gotcha.
So now we'll go on to inverse correlations. So we'll talk about the dollar index and the VIX.
Okay.
Did you want me to start with one or the other?
Yeah, it doesn't matter. Either or.
All right, sweet. We'll just start with the VIX. What do you know about the VIX so far?
I'm still just learning about the VIX. From what it was telling me, voluntary strength index. Is that what it is?
Yeah.
So just it's based on what is post market or pre market of what people think. From what I was reading.
I read that as well.
Yeah. So that's basically all I know.
I read that. I tried to make sense of it,
yeah.
and I was like, it doesn't make any fucking sense. I'm just gonna see it. I'm just gonna see it as an inverse market that respects gaps.
That too.
Yeah. What the hell is this volatility index that tracks how fearful people are of them? What the hell are they saying?
Yeah.
We don't need to care about that. We just need to know that this can be a pretty powerful tool to find a directional bias, especially since I think when we were talking before, I got you to look at VIX on like a higher time frame.
Yes.
Just to see like what the hell is this chart? I looked at this for the first time a while ago and I was thinking, wait a second, why does it look like there's such a key area of support, key area of resistance being respected yearly and monthly? Like this is a whole year. Like this whole year was just traveling within the range. Like if we had this key area of support and this key area of resistance, and then I started to test how sensitive would it be in the very low time frames. So like I have all these random gaps outlined, but just for example, today's gap, I had this one outlined, opens at London session. If VIX opens and has a big gap underneath, then VIX has a tendency to fill gaps.
Gotcha.
So if it fills the gap, that means VIX will have a tendency to be bearish. And if VIX has a tendency to be bearish, what does indices have a tendency to be?
Be bullish.
Yeah, has a tendency to be bullish. So if we have that in mind, if we want to see bullish on indices, we can't, you can just base it on VIX, but I like to have other reasons to be bullish. For example, like objectives, like liquidity, like this. Like, what the hell is this? What do you think I'd call this?
Relative equal highs.
Yeah, like it's a generation of liquidity, like equal highs. So now we have reason for NASDAQ to be bullish. We have reason for VIX to be bearish. You see, like VIX is like that little treasure hunt. We found a little hint that's going to tell us that indices will be bullish. NASDAQ gave us a hint that there's reason to be bullish because there's money above. If we have a look at SMT, we don't have that hint, right? If we only look at S&P, we're like, this is just a swing high. I don't know what the hell this is. It's just a swing high. Doesn't matter to me.
Yeah.
If I look at the Dow, where's that swing high? Nothing is too interesting. It's just a swing high. Like these are just swing highs. Nothing too interesting. So it's like whenever someone has a bias at the start of the day, you're either looking at some random swing high and some random swing low, and if they're choosing between these two, you're just guessing. It's not even an educated guess. You can be educated to an extent, but to me it's just guessing. There's no high probability of one or the other.
Gotcha.
I always try to look for high probability environments. Right? So if we look at the Dow, we can't see shit. If we look at S&P, can't see anything. If we look at NAS, now we have a reason to be bullish. And if you pair that with VIX having a reason to be bearish, which it does, excellent. Maybe DXY even has a reason to be bearish. I don't know, does it? We have a swing low here. It doesn't look like an equal low. So not as much of a reason, but VIX had a reason, NASDAQ had a reason. So we have two strong reasons for bullishness.
Gotcha.
And if you have that bias in mind, then as the day starts, maybe you're waiting for 9:30, maybe you're waiting for sentiment to be induced or whatever, then you're only filtering for bullish RMRs. So maybe it's like you're waiting for these swing lows to break, waiting for this to break. And as soon as they break, then you're going to look for a market structure shift. So you're waiting, it doesn't shift, it raids again, it still hasn't shifted. Okay, it broke a swing high here. It formed an equal high there. We had a tiny gap in here. Maybe that could be your entry, but it doesn't reach. Does another gap form? There's one that forms over here. So that might be your entry. And so if you're only looking for bullish trades, then if this is your, it does reach here, if you're patient enough, I guess.
Yeah.
And at that time, what do you think I'll do? If I'm looking for that bullish trade right there, I have a bullish idea. What do you think I'll do at that entry point?
Look for which one is the strongest.
Yeah, exactly. I'll look for which one is the strongest because I want to participate on the one that's most sensitive.
Gotcha.
So if I draw a fib, just draw it here, that to the high, bottom of the raid, top of the shift. Let's go to Dow. Okay, let's do it again. Bottom raid, top of the shift. This looked pretty bullish here.
Yeah.
Okay, so NASDAQ, what is that, 60%? Dow, 70%. Which one is stronger?
The NAS, you said 70%?
NASDAQ 60.
Oh, I'm sorry.
60, and then Dow to 70.
Dow.
Why?
Dow, because when it's in bullish, you wanted the strongest one, right?
Yep. So which one is the strongest?
It would have been the Dow, correct? Because it's at 70.
I think I know what I think I know where the road bump is. It's when the deeper it's retracing, that means the more bearish it's going.
Oh, okay, got
So
you.
so the more bearish it's going, the weaker it is.
Got you.
Yeah.
So
So
so the one that has less retracement into it is the best one. So I've been in the NAS.
yes. Yeah, exactly. So Nasdaq retraced the least. So it's trying to retrace, but it's getting stopped because it's pretty strong.
Mm-hmm.
Dow is trying to retrace. It's retracing quite a bit, but it's getting stopped here. So Nasdaq retraced a little less, so it's stronger.
Got you.
I'm just going to take out S&P, and then you can compare Nas and S&P, and you can tell me which one is stronger. Okay. Oh, jeez. Okay, so Nasdaq retraced to 60%, S&P retraced to 80%. Which one is stronger and which one's weaker?
The stronger one is the S&P. The weakest one is the NAS. Am I saying it correctly? Well, I was done.
Oh, wrong way.
Wrong way.
Wait. Why you think? What's your thought process? We'll try to clear this up.
Okay.
What's your thought process?
Only reason why I thought it was stronger because the deeper it went in, so I thought it was stronger. But the weakest one would have been the SP 500, and the stronger one would be the NAS because the NAS had the lesser retracement in the Fibonacci.
Yes, exactly. I think I figured out a way to explain it that makes more sense.
Yeah.
Sometimes I say stronger or weaker. It gets a bit confusing whether it's stronger or weaker in the chart or stronger and weaker in the retracement. So what if is this clear? Is it clearer if I say which one is more bullish?
Yes.
Is that clearer?
That'll work. Yeah. I was
Okay.
wondering. Yeah, which one basically is less retracing the Fibonacci?
Yeah. Jeez. Oh my god. It's like a bunch of circles. Yep.
Yeah.
Less retracing the Fibonacci. Yep. Stronger is the strongest one. Okay.
Gotcha.
Yep. So at that time, that minute, because relative strength should be a very quick step because it only matters at that time. Like no one cares what it is here because it could change. It could be the strongest here, could be the weakest now, could be the strongest now. But at this point, when you feel like entering, that's when you apply relative strength.
Gotcha.
So at that point in time, we found Nasdaq was strongest. So we place our long on the Nasdaq, stop, bottom of raid, target up there to the equal highs and objective, and you can partial along the way wherever you feel like, right?
Yeah.
And then if we just do a quick comparison, which one looks stronger? Where's this high? So it's here. So S&P and Nasdaq look pretty similar actually in strength. Nasdaq might be a bit stronger.
Mm-hmm.
And if we compare with Dow, Dow looks like it had a smaller bullish pump. Yeah. But how would we predict this? We can't predict this unless you're doing something over here with relative strength. No one's
Gotcha.
no one would be able to predict that Dow would have a small pump, Nasdaq would have a bigger pump, unless you're looking at just before that pump, at that entry point, and applying relative strength at that point.
Gotcha.
This is a good example. I just want to, because I think I mentioned this bullish leg here. I was saying that that leg on the Dow looks much stronger.
Mm-hmm.
So at this point, Dow was much stronger, right, during this bullish leg.
Right.
But then at the time of the entry, it changed. So Dow was actually weaker than the Nasdaq. And so what happened to the pump? Which pump was stronger?
It was the NAS.
Yeah, because it's not. So I think my point is, whatever happened before, it's much less relevant. Whatever happens at the time of the entry is much more relevant to what the move is.
Gotcha.
All right, sweet. Okay. Any questions for now?
No. I do see what you said we'll discuss later is really understanding the raid and the entry. Like I kind of got mixed up with where to enter at, because I see that you said price kept on going for higher highs. It didn't really turn to after raid, the second one
Down here?
yeah, it started turning price didn't start turning till after the second raid.
Oh, yep. Over
Yeah.
here. Yep.
Yeah. Even though price was keep going up and up and up, like it didn't happen till after the fact.
Until New York session, yep.
Yeah.
So
Yeah.
this is kind of like a time factor.
Okay.
The key times to look out for to reach key areas are generally the start of London session, the start of New York session, or the equity open and news.
Gotcha.
So this time, right in between, what is it, 5 and 7? This is. Do you know what this time is? Between 5
Yeah.
and 7-ish?
Isn't that London time?
Yeah, it's like London lunchtime.
Okay.
So that's just a time where it's less volatile.
Gotcha.
This is a very generalized statement. I usually don't even care about this, but if we want to nitpick and find reasons, like within price action, this is probably a big reason. Just because it's London lunchtime, it's saving the volatility for a time when more traders and more money is in the market.
Gotcha.
Like all this time from 5, let's just in hindsight, from 5 a.m. New York time to 8 a.m. New York time, compared to 8 a.m. to 9 a.m. New York time, which one do you think has more traders?
The New York time.
Yeah, obviously.
Yeah.
So it's saving all this movement for a more volatile time. And that's what you'll notice with whenever you have like really key areas. I would say this is like a short-term key area, nothing too interesting. Like a really key area would be like something that looks stupid clean. I think I say that a lot, but like a daily time frame. Actually, we actually passed something stupid clean recently, but like what the hell is this? Like all these 4-hour lows, like, and then another 4-hour low generated there.
Yes.
Like, that looks stupid clean, right? Like, even if you had to predict, when do you think these lows would be taken out? What time do you think it'd be taken out? Just guess.
New York.
Yeah, I'd guess New York time. I'd probably guess like a high impact news, maybe like an 8:30 news or a 9:30 equity open.
Yeah.
I have no idea. I'm just having a look, but we go there. When was it? 8:30, right? What the hell happened at 8:30? Probably news, high impact news. Yeah, and then after high impact news at 9:30, then what? Like the key area was taken, so your bias is gone. So whatever happens after your main bias is gone is going to be more difficult to trade towards. So this will be harder to trade towards. You won't have as clear of an objective. You can't tell me that this is your key objective, this gap. What the hell? Like, it's just a gap to me. It doesn't look that interesting.
Yeah.
but like these 4-hour equal lows, like this was so interesting. It's just but it's just a shame that it didn't have at 8:30 like a raid, like to take out all the buy side, have like a shift and then a retracement into a return and then done. Oh my god, that would be perfect.
Yeah.
but this actually happens quite often during high impact news. It'll manipulate completely the other side, shift the structure, form a gap, entice so many people to go short to the main objective, but the main objective has not been reached yet, and then have a retracement into a gap, and this is where we'd enter, and then we short it. And that's basically what the RMI is. It's waiting for that manipulation, waiting for a shift, and that shift's purpose is to entice people to FOMO. And then that retracement is the purpose, is to make those traders from that shift get stopped.
I have to do more exercise because sometimes it's hard for me to see the RMR shift happening.
Just like the visualization of it.
Yeah, like I always think that after the shift, it should be another raid to the low of the raid before I get in. Then sometimes I see it don't happen. Sometimes I do see it happen. So it's like, okay, I gotta really start doing some homework on that.
Because the market is never the same. It always changes.
Yeah.
So we use things like a fib, a gap, an order block to allow our entry position to have some leeway. So we don't have to be perfect on our entries.
Yes, there. Like I would think it have to go back into the fair value gap or something like
Yeah.
that.
I was gonna say that. Like this would be my entry. I would wait for a deeper retracement.
Mhm.
If we use a fib, I would never participate under 50% unless it's the weakest or the strongest. That's a different point. But on this one, it retraced almost to 50. Didn't reach it, to be honest.
Yeah.
Even on this one, this deeper, this one retraced to 50. So if you're looking for a second entry, so maybe this one, you realize that it's a bit too far to reach for the day. Who knows? I don't know that. But if you use the different gap, like this different gap here, then you could use that one as your return entry. But I think the point I'm trying to make is with your entry position, whether you're entering on a gap or entering on an order block, like this is just one massive order block. Like you can see it's just chilling in that order block.
Yeah.
You can choose how optimistic you want your entry price to be. Have you heard me say optimistic before?
No.
Okay. No, this is good. I think this is a good point. When you have your positions, I like to talk about them in terms of how optimistic your entry point is. What I mean by that is the more optimistic you are, that just means the better the price you want.
Okay.
So let's say my A plus entry, my most optimistic entry would be to fill into this gap overlap, right? There's a gap there, there's another gap there, it's overlapped. So this is a key area. It's going to get filled regardless, sometime sooner or later. It gets filled later, but whatever. But over here, this would be my most optimistic entry, because it's the more optimistic it is, the better the price is, but obviously the better the price is, the less likely it is to fill.
Gotcha.
Okay, so if we are a little more conservative, like when we don't care for such a good price, we want like an average price, maybe just at the bottom of the gap. Just reach the bottom of the gap, I'll be happy.
Mm-hmm.
But it doesn't reach that. We're still too optimistic. Like price could have gone into there, or price could have gone into there, or here, and then dumped. We don't know this, but we're just choosing for this specific trade how optimistic we want to be. And for this specific trade, this massive order block, this one, this big order block, I don't think this is reached either. Oh, it gets tapped here actually. Yep. So if we're like a very conservative entry, we don't care for optimistic ones, then if it just retraces to here, then we'll have our entry. So it's more likely to reach conservative areas. But obviously you don't want to participate if it's like a tiny retracement like that, and you want to enter there and then have your stop all the way up there. Like this is just not worth it unless your objective is far away.
Gotcha.
Because there's no point putting your stop loss in an area of invalidation. What that means is if I just put my stop loss in the gap, here we don't get stopped out, but the point is the gap is not an area of invalidation. So my trade idea can still be correct even if this trade is wrong. So even if price stopped me out, didn't reach that high, if it just stopped me out during a retracement and went down, this trade would have gone stopped out. But my trade idea would have still been correct. So the whole point of the stop loss is you want to put it somewhere where your trade idea will be incorrect. Because if I just put it like somewhere random, like this high, then like obviously any bullishness it's still just a retracement in this big leg. It's not invalidating your trade. That's why whenever you place your stop, I usually always put at the top of a raid or bottom of a raid. Because if price reaches that, the idea is done.
Yeah.
It's obvious that your idea is invalidated. You're just wrong on that trade idea. So when you have feelings of, oh, should I get out here? Maybe I want to increase my stop, or whatever goes through your mind. Because you put your stop at you just got to remind yourself, you put your stop at an area of invalidation. And if it breaks that area, your trade idea is wrong. So you're less likely to move your stop because you already accept. Yeah. Whereas if you put your stop like here and you set your risk to be like 1% over here, if price goes and stops you out here, you might be like, oh, but this is just a gap. I'm not invalidated. My idea could still be correct. Trade could still dump. So you're like, oh, maybe I'm going to increase it. And then suddenly you're risking 2%. And then you're like, but even if price gets to here, I'm still correct. Like my trade idea is still correct. But you might get stopped here, but because you think your trade idea is still correct and it's not an area of invalidation, you're more likely to just adjust your stop or do something not planned.
Gotcha.
So that's a little, that's my take on stop losses in areas of invalidation. And
oh, thank you. Get that. I'm glad you discussed that.
Okay, good. Just random topics that come into my head that I think.
Yeah, no worries. When you were saying, so even with the raid, the entry, like, okay, we didn't able to get the entry. How do we know that, okay, we missed that entry, but what be our objective as our exit? How about, because we don't know what if it goes back up to there, but if it doesn't go back up to there, when do we know that, okay, it got to a point to where the trade, even I was right, my entry didn't get hit, but showing me that I should have exit here and then don't try to get into that trade again. You get what I'm...
Yeah, understand. Whenever your main objective is reached,
okay,
your trade idea is done.
Gotcha.
If price reaches a partial location, let's say I want a partial at this gap in here. Like we've got a short in there. Our main objective is this. Oh, we've got an equal low down here. Let's just say that this equal low was our primary objective, and this secondary equal low was our first partial location. So if price has reached your main objective, obviously when price retraces into a gap, you don't want to go for another short because your main objective is done. That makes sense, right?
Right.
Okay, so now we enter the gray zone of if price takes our first partial. So this was a pretty logical partial area, like an equal low, but your main objective is still untouched over here. And in fact, your main objective actually created an equal low like this. Then there's a few factors that come into play, like time. If there's still more time in the day for volatility to reach a key area, then if price gives you a fair enough retracement, then it's okay to enter because your main idea is still in play.
Gotcha. Okay.
The thing I'd worry about in this case is time. Like it's not in New York session, it's not in London session, it's an Asian session. We know Asian session's always consolidating, right? There's nothing going on here. There's nothing going on here. Like I'm just picking random days. There's nothing going on here, right? It's much less likely to reach a key area during Asian session. So over here, if our main objective is not touched yet, I wouldn't be looking to enter in Asian session. I would be looking to enter when it's more likely to reach. So in the London session, perhaps. So I'd be waiting for London session to present a short-term bearish RMR because that's my entry technique. I'll wait for some sort of raid during London session, like a manipulation leg, because at the start of the session, there's usually a manipulation leg. It's a very general term, but if you just have a look at most starts of sessions, it's usually a manipulation. Start of the session, it's manipulation bearish. Start of the session, it's manipulation bearish. Like, you get the point.
Yeah.
So what I would do is I'd wait for London session manipulation. This looks like a logical area it could manipulate to. Maybe a market structure shift, and then enter on that gap, and then still use that target.
Gotcha.
Yeah. What did I say? If you didn't get your entry, like if this was your entry and you didn't get it and it just started dumping, I wouldn't enter if it's not planned, which means I would never enter, like, you see it dumping, I wouldn't enter down here. Like, as it's dumping, I wouldn't place a short.
Okay.
Because it's not an entry technique. Are you entering on a gap, an order block, a fib?
There's nothing.
There's nothing. It's just it's a FOMO. You're FOMOing, right? It just straight up, you're just chasing price. So if you really, and you're desperate to enter, like you're just full on desperate to enter, at least do yourself the justice of waiting for some sort of retracement to some sort of logical area. If you can't wait for this, at least wait for this, or at least wait for some sort of logic behind the entry.
Yeah.
Yeah. So price can so easily just go to this and then dump. But if you're that desperate to enter, do yourself the justice of waiting for an entry method. Whether it's, so here there's a gap. If you go out to the left, it's a breaker, or whatever entry method you want to use. That doesn't matter. But use some sort of entry method, not just a chasing price method.
Gotcha.
Yeah. Did that answer your question?
Yeah, it did. It did.
Nice.
Because sometimes I feel like I miss it, and it gets me like, oh man, I missed it. I just don't validate the trade, and sometimes I do see where it does go back to it, to a certain area.
Yep.
But you did make a very good point as knowing what my objective is at the end. So I got it now.
Okay, excellent. I just want to touch on this one to use this as an example. If this was our main objective that we saw, right? These equal highs. And if we didn't get our entry, let's say price didn't retrace to that little yellow box. Our yellow box is down there and we didn't get it. When price is pumping, obviously we can't get in there. We don't get in there. If you're desperate to enter, if you're not desperate to enter, I'd wait for a retracement, right? It's easy. You just wait for the retracement, enter there, stop loss, bottom of the ray, easy. Just keep going. That's as long as the equal highs aren't taken. But if you're desperate to enter, then obviously do yourself the service, wait for a gap, wait for a retracement. Let me just go to one chart. Like, that's kind of a gap, right? Like, we can argue if that's a gap or not. That's a little gap. That's a gap. If we don't get that, wait for a gap, okay, there's a gap here. We draw that out. Actually, I have a replay function now. Times 1. Okay. So we're waiting. Okay, so if we didn't get that first gap, we're waiting for another gap to form, and okay, a gap's formed, right? So right then, our main objective has not been reached, so there is still more reason for price to pump rather than to dump to just a gap. Liquidity will always be kept in mind more than a random gap that's formed. Because there's money in here. The purpose of so when I talk about price only goes to two things basically. It either goes to liquidity or it goes to gaps. The purpose of it going to liquidity is to make money. That's a pretty strong purpose.
Yeah.
The purpose of it going to a gap is to offer the price that wasn't offered in the past. It's not gonna make as much money. Liquidity is gonna make the money. This is just an obligation that they have to do. It's just how price works. They have to offer it if it's not offered. Like there's not going to be many traders placing their trades in here. The spread's just going to get you up there or down here. So price is obligated to let people participate at this price.
Gotcha.
So this area of liquidity is king. Liquidity is king. So if that's not reached yet and you're desperate to enter, like you don't have the patience to enter here, you just have to accept that when you place your entry in here, chances are you're not going to put your stop down here to just make that much. Chances are you're going to put it at a different swing low like here and at least get like a 1-to-1 at least, right?
Yep.
But you have to just keep in mind, because it's an aggressive entry, that your stop loss, once again, is not in an area of invalidation. It's an area of like a short-term but it's not an area of invalidation. Price can easily dump to this gap and then pump to your objective, and your idea could be correct.
Yeah.
Yep.
Trick.
Yep. So that's the main thing about these aggressive entries is your stop. You just have to come to terms with it, accept where you want your stop to be, and if you're desperate, just say fuck it, enter on the gap, and then just place that trade. So this would be that trade. We wait for the entry. Okay, we get filled. We have our stop down there. You might get stopped in a minute or 30 seconds. It's pretty normal. Start shooting bricks. Just wait.
Yeah.
Okay, I don't even know if it gets hit. Actually, it does. I remember. Wait.
Okay.
But yeah.
Yeah.
And then in the end, it gets hit, right? So your stop loss was in an area of short-term invalidation, right? So if it breaks this swing low, it's short-term market structure shift. So that's why you don't want to put it like above that low, because then it's just a retracement that you're going to get stopped on. At least put it to a swing low.
Yeah.
So this would be an example of how to get in if your main entry was not reached and price is leaving you, but it hasn't taken out your main objective.
Gotcha.
All right. Okay, I think that's quite a lot of information.
Yeah, I got it.
But I record everything, so you can listen to it back, so it should be all right.
Awesome. I might do one more just explaining, because I know we're running out of time, just the whole the RMR trading aspect of it.
What trading aspect, sorry?
When you doing the raid with the look for, like that, I got to
look for raids.
Yeah, and look for market shift. That was my thing.
Okay.
And one more thing that I wanted to ask you on the VIX, which I wrote it down, but I forgot to ask. When you saw the gap between it, what time frame was that on?
This one?
Yeah, was that the daily or?
This is the 5 minute.
Oh, 5 minute. Oh,
yeah.
okay,
So
gotcha.
every single day there will be some sort of gap. It doesn't have to be significant like this one, but when it is significant, then you want to take advantage of it.
Gotcha. Okay.
Yeah. So like this, we had like a big gap up. So if VIX has reason to go down to fill it, indices have reason to go up. But you don't want to blindly follow VIX. You want to have some sort of reason. Like today was actually a perfect day to use that example. Like we had that equal high on NAS, so we had reason to go up, and VIX had reason to go down.
Gotcha.
Yeah, and on S&P you couldn't see the high. On Dow you couldn't see the high. Like you can see, Dow hasn't even reached that high yet.
No.
S&P just reached that high. And NASDAQ has reached that high much earlier.
Gotcha.
And the reason for that is because at the time of our entry, we applied relative strength.
Gotcha.
Yeah. Okay. I actually want to talk about the exercises because I kind of just the psychology. Do you have a bit of time?
Yeah, I have time. Yeah.
Oh, okay, sweet. Actually, I'm going to list off a couple topics and you can pick one and then we'll just talk about that one.
Okay.
Yeah, just to end it off. So this is what I had left. I wrote Forex correlations, just if we have time, but since you don't trade Forex, may not be the most relevant. So that's one topic, just Forex correlations. I think the main point in that is just to find, to treat it as like a treasure hunt, because why don't we only look at NAS? Is like people can trade just looking at NAS. Like you can be successful like that.
Yep.
Like same thing. Like you can just trade S&P and not look at anything else. But if you don't look at NASDAQ, you're not going to see those equal highs.
Mm-hmm.
If you only trade S&P, if you don't look at VIX, you're not going to see that gap. And
Yep.
just from that, who's going to tell why it's going to pump? Like, what are you going to say? It's just going to retrace to 79%, respect the 79% level and pump?
Yeah.
Like everyone says that, but why is it pumping? What is it reaching for? And then they're going to say, oh, it's reaching for this swing high because this is a key area of liquidity because it's the previous day's high. Yeah, sure, it's the previous day's high, but is it more significant than previous day equal highs that were generated, as well as a VIX open gap? Like you see, they're missing so many things.
Yeah. Yeah. Confirmation.
Yeah, like so many different correlations and like treasure hunting. That's basically why I have all these pairs.
Got
I'm just treasure hunting.
Gotcha.
Yeah, that's it.
Cool.
So I think that's like the basis of how to use correlations. It's just doing the same thing on every chart, just finding out if there's a clean area of liquidity, and if there is a clean area of liquidity, then you can find a correlated market that you trade and use that as a hint. Yeah, like even if you don't use relative strength and you just use indices as correlations just for objectives, then if the guy only trades Dow, but he uses NASDAQ as correlations, he might see the equal highs, and then he'll long the Dow. He won't apply the relative strength because he just doesn't do that. It's not part of his strategy.
Mm-hmm.
But he'll use that NASDAQ to find that hint to be long.
Gotcha.
Yeah. Okay, the next topic was daily bias analysis, but the main thing in that was pretty much liquidity generation whenever things aren't clear.
Gotcha. Yeah.
Because if things are clear, it's just clear. It's obvious if things are clear. You just, like, we start on a high time frame, see if anything is nearby. Like, what was the closest things in here? We have a gap in here, we have a swing high, and what's below? We have a swing low, another swing low. Oh, okay, it's like an equal low. Okay, that's why I have it labeled big equal low. Like, it's probably going to be a key area.
Yeah.
But then we'll zoom in a bit. Is it close? Is it far? Okay, it's pretty damn close. All right. Is there a reason for it to go there? Like when will it go there? Like a New York session, during news? Okay, let's check news. Oh shit, Friday's NFP.
Yeah.
Like things are lining up. And then you're just like, oh, if it doesn't go to this, where else would it go to? Well, we've got this massive gap, but what does it prefer? Obviously, price prefers money other than a gap. But you can see that even if you placed a short in here, you're still invalidated. So it's like a lower probability environment because there is reason to go up. It's not just like a one-sided sort of thing. But when you have like, we haven't even treasure hunted yet. Maybe tomorrow, NFP day.
Yeah.
What if VIX, in order for indices to go down, VIX would need to be bullish. So if VIX tomorrow opens like down here and leaves this big ass gap, then VIX would have reason to go up. And then indices would have reason to go down. So that would be a little treasure hunt.
Gotcha.
Yeah.
You know, if the opposite happens, then we look for that too.
Exactly. And then if things aren't clear, then we just go lower time frame and we find generation of liquidity. And that's when we went to like a pretty low time frame, and then we saw, okay, we've got a generation liquidity here.
Gotcha.
Yeah.
I was thinking tomorrow well, from what I've studied dealing with ICT, like tomorrow is Friday usually is a reversal and it goes to the Sunday's open. So I was more looking to that, which shows right now is the gap. But also too, you make a very good point that it might just go to where the money's at, to liquidity. So yeah, it's a 50-50 scenario, I guess.
There's reason for both sides of the market.
Yeah.
Yeah, so in those scenarios, we wait for generation of liquidity. Like the day could start, and then let's say like these highs are just completely taken. And then before 8:30, let's say 8:30 is over here, like we get close to those lows. And what if we just form like a million equal lows? Wait, didn't draw that right. Like a million equal lows down here, and is like here. Then we have so much more reason to go lower. We've enticed, we've taken out buy side liquidity. So we've, all those people that are long, we've enticed them, they got stopped. Everyone, all those longers that are too scared to short now, all the people shorting at resistance, they got stopped. So they've taken out one side of the market. It's more likely to not take it out again, because we look at it as why it does what it does.
Yep.
So the reason why you would do this is manipulation, and then maybe during news release, because it's NFP, who knows, maybe it might release again, like manipulate again before doing something. But high impact news, you never know what's going to happen.
Yeah, we never know. Stay out.
Yeah. Stay out as in never enter like a minute before news. Holy shit, the people that enter before news, oh my god,
it will hurt you deep.
It will. But after news, maybe like because RMRs take time to form. Like it's not just going to form in a minute. Like if it's 8:30 at this time, it might have that raid, it might shift, it might return. Like this is going to take maybe like 5 minutes at least, 5-10 minutes, whatever. But then you can trade. You can, if you have that entry and you have that objective, you can still trade that.
Gotcha.
Yeah, because the spread's not fucked. Like you're not going to get destroyed by spread.
Gotcha.
Yeah. So the next topic. Okay, so that was mainly daily bias stuff. So generation of liquidity. I wanted to talk about range anticipation, but long story short, it's just after long range days we expect shorter ones. After shorter ones we expect bigger ones.
Okay.
And the previous day high and previous day low are. Sorry, I'll drink some water.
Don't worry.
Okay. And the previous day high, previous day low, one of them are bound to be taken. Like this is not a strategy, but it's just good to keep in mind that on every single day, it's like a 90+% chance that one of them is taken. And then on the days that it's not touched, that either aren't touched, then the next day is even higher chance of one being taken, or both if it's a higher news event.
Gotcha.
Like we can pick some random small range day. So we'll look for a big range day, because after that is a small range day. Like here, like what is this? This is FOMC, 100%.
Oh yeah.
Yeah. 100% this is FOMC. What the fuck is this? But yeah, after this range, we have a small range, right? That's previous day low, that's previous day high. For the whole day, you can't do anything. So what's everyone online going to say? Everyone online, including ICT, is going to be like, oh, this is high resistance liquidity run. This is very difficult to trade in. And then he's going to be like, you can see how price is barely moving from point A to point B. Price barely moved. Wouldn't you rather trade in this environment instead? Like, yeah, I get what you're saying. But like in these environments, like if you're a day trader, these are like the perfect environments to trade based on liquidity generation. Like these are the perfect days where constantly, like I'm on a 15-minute time, but on a 5-minute or whatever minute, like this is gonna look like a super clean equal high area. Somewhere down here, these are gonna look like equal lows somewhere down here, or whatever. And then just with that in mind, we look for bullish RMR, like maybe like we have equal lows here as well. On a 1-minute chart, this would look really clean.
Yeah.
So if we look for that raid down here, we wait for a market structure shift. It doesn't shift yet, it doesn't break this high. and then we see price rated again. It raids at 9:30, a specific time of day. It shifts in structure. We can't tell because it's a 15-minute chart if it retraced, but it raids. Might have. Let me go to a different time frame. I'm gonna find this out. Let's go to 3 minute. Okay, maybe I can zoom far enough. Okay. All right, it didn't give any retrace. Actually, yes, it did. Over here. So we have the raid. It pumps. It breaks structure, so breaks swing highs, and then it retrace. We have this tail. So whatever happened in here, it candle opened and it retraced. So it doesn't look like a gap is in here, other than this one. But when the candle formed, this is a different concept, but when the candle forms, there's automatically a gap in here. And so this candle retraced into the gap, and it retraced into this order block. So this would you'd have to be very, very nimble. But in here we have a bullish RMR. You have a raid, shift, retraces, and then pumps to equal highs. And then you have all these lows that aren't touched. These equal lows. So maybe we look for a raid, we look for a shift, price retraces. Maybe we want to be optimistic, we don't get it. If we're a bit more conservative and we wait for like a big order block retracement, then price retraces into here. And then you short anywhere in here, target equal low.
Gotcha.
It's another quick one-to-one. Like in these environments, liquidity is always generated short term, all the time. Like, and these are actually like the funnest days for me to trade.
Yeah, because it's just going short term.
I can just feels like it feels like I'm doing a bit more than just nothing. But I don't mind doing nothing.
Yeah.
Oh God. That's my alarm for 9:30 equity open.
Oh yeah.
Ah shit.
I just turned mine off. It just went.
Oh, yeah. Very nice. Yeah.
Well, I'm not talking. Good.
I think we might call it there actually, because it's equity open sometime soon.
Okay, no worries.
I did say I wanted to talk about the psychology exercises, but I'll just send them to you. I'll message you them, and yeah, I'll just message you them and how to approach them.
Okay. Also, too, what if you could send me the videos on? Like, I wanted to go over maybe one more thing. I'll book some more time later. Just identifying the raid, and
Identifying the raid?
Yeah, identifying the raid, and like that was kind of like one of my problems. Like, okay, I see it here, or identifying the market shift.
Okay.
Yeah. So if I could find out or do some practicing on that, or even you have videos for me to look at, or we could book another session to really go into depth with that, because that's kind of like Achilles heel right now.
Okay.
Because
that's like, I see. Yeah. Because I feel like that's like the crux of the RMR. So you gotta get this part correct first, and then you can always add like the confluences and whatnot.
Gotcha.
Yeah. Since all my videos are basically the same strategy.
Okay.
And none of the raids or none of the market shifts will look the same. So I think just spam through my videos just towards the raid and market structure shift section, and then just compare and contrast like the different types of raids, different types of shifts, and then you'll just have a baseline understanding, I guess.
Okay, I'll do that. Went off the first 1, 2, and 3. I keep looking at that one.
Okay. Oh, yep. No, that's good. You name it however makes sense to you, and then, yep, that's it.
Cool. Well, thank you. I really appreciate it, AZ.
Oh no, it was my pleasure. I enjoy teaching, so it's all good.
Awesome.
I hope you learned something during the session, and hope it improves your trading.
Yes, and I might book some time later on after I do these exercises and everything, and if I have more questions, I'll book some more time if you have free.
Okay, yep, that sounds good to me.
Cool. Well, you have a great day.
Oh, yep, you as well. Look forward to Equity Open 9:30.
Yep, same here.
Right. Take care, Gary.
All right, take care.
All right, bye-bye.